Good evening, everyone. On behalf of HDFC MF, I welcome all of you onto this call. As we are aware that the Indian equity markets have been quite volatile in the recent past, and it has been the case because of how the geopolitical uncertainty has folded. Indian IT in that context has also remained quite volatile, and in fact, the correction in the Indian IT indices have taken place much prior to the conflict having started, and it has been mainly centered around how artificial intelligence has the conversation around that has panned out. And as we are aware that there has been a lot of chatter as to how AI could pose a big threat to Indian IT services, and whether there is some truth to that or is it a myth. We have to really understand that at a deeper level. And to do that, we have with us Mr. Balakumar B, who is a fund manager for our HDFC Technology Fund. He's also been an analyst in the IT space for quite some time, and it is he comes with a very vast experience. And to take you all through the key discussion points at this point of time, I invite him over to take on to this call. Bala, I hand it over to you, and thank you.
Sure. Thank you, Aditya. Thank you, everyone, for taking your time out. I wish you all a great evening. Means without much ado, probably we will just get into the presentation. In this presentation, probably we will touch upon some of the key themes or the questions or discussion points which are on investor minds with respect to investing in the technology space today. Of course, the most important talking point, as Aditya also mentioned out in the intro, is artificial intelligence, AI, and the potential impact on the Indian IT services sector. Last 2.5 months, I would say, especially February, we saw a sharp correction in the Indian IT services names, mainly due to concerns over AI. And this is part of I would say, a global trade where we saw software as well as services names across the globe saw a sharp correction due to concerns over potential impact of AI on both the quantum as well as the durability of the growth. We will discuss our view in this section going forward. In addition to AI, whenever we have had investor interaction, I think there are few other topics which also come up very frequently. Probably we will touch upon those topics as well. One is the H-1B visa restriction, the recent fee hike on the new visas, and what's the impact on the operating model for the Indian IT services players. Two, last 3 years, we have seen slowdown in Indian IT services revenue growth. The growth rate trends below what the growth rates were pre-COVID as well. So the question naturally is whether it's a structural slowdown or a cyclical slowdown. And three, in our fund, our HDFC Technology Fund, we could invest in IT services or the broader ambit of IT, telecom, as well as internet. And with respect to internet, we have been hearing about a room for increase in internet penetration for the past decade or so. And today, do we still see further room? I think that's another discussion point, which always comes up during our investor interactions. We will touch upon all these topics in the coming slides. First, on AI. I think this has garnered the most mind share probably among technology investors over the past 2.5 years. And it's a clear, let me make it very clear, it's an evolving trend and a more nascent as well as a global trend. The adoption is still in nascent stages, especially with respect to enterprises. Possibly to understand the impact, we try to look at what were the technology changes which were happened in the past 3.5 decades, and how this has impacted the tech spends. Because today, I think there are three prominent questions which come up whenever we discuss AI. One, because it promises productivity savings, how does that impact the overall technology spends? Will the technology spends decline year on year over the medium to longer term perspective because of the productivity benefits which AI could produce. And second, IT services, will they remain relevant in the post AI world? Will they lose their relevance or can they adapt? That's the second prominent question. And third, in terms of jobs, what's the potential impact due to AI? I think these are the three prominent questions which have been getting. Probably, if you look at the first question, the productivity benefits, if you look at any of the previous technology trends, the major business or technology changes, be it offshoring, which focus, which leverage the labor arbitrage, and second is enterprise software, which means all these technology changes are, they came on with a unique value proposition, or I would say one of the key value proposition was efficiency, that there would be productivity savings, be it offshoring, be it enterprise software, and R3, I would say in the past 1.5 decades, the adoption of cloud. So you don't have to, enterprises don't have to own hardware, they don't have to own platforms, they don't have to pay perpetual licenses on a software. You can do everything on a pay as you go basis, which is the cloud model. All these three, I would say, or even other major technology changes which we have witnessed in the past 3 decades, one of the key value propositions was efficiency or cost savings. So ideally, all these, when they gain scale, they should have led to lower technology spends in absolute dollars. But if you look at the right hand side, we have given both the IT services as well as the global technology services spending in dollar billion amount. You could see every every year, I would say, over the past 15 years, we have seen the spends of both uh, overall technology spends as well as services spends, which is a subsegment, both recording increase in dollar spends. So clearly, despite the efficiency, the dollar spends only continue to improve. So this is mainly because when you have an technology which lowers the cost, then thereby it naturally increases the TAM, the number of use cases for which you can use technology, or the number of enterprises which can use technology, then the bar gets lowered. So the TAM, or the total addressable market, increases, only because of which we have seen this technology spends grow over the medium to longer term. We think as AI also gains scale, like I said, we are still in very nascent stages of enterprise AI adoption. As enterprise AI adoption gains scale, we expect the same thing to play out, that there would be growth in global technology as well as services spends. And second, the question on whether IT services firms will stay relevant, or will they or can they adapt to the new model. So this question has been asked time and again, and one such example is in the past decade when the cloud models started gaining scale, because then the question was that it will reduce the need for integration or customization requirement from services providers. So possibly this could lead to lowering of deceleration of growth. If you look at the growth rates over the past 10-15 years, of course, the growth rates did decelerate during the initial phases of cloud adoption. But as the enterprise AI adoption gained scale, we saw growth rates stabilize and improve among players. Of course, whenever a new technology comes, it creates, it widens the disparity in terms of growth within the ecosystem. Companies which adapt, they grow faster. Companies which are slower to adopt, they possibly cede market share to companies who were more proactive, and then they would be gaining market share. So if I look at the last cycle, you could clearly see in the left side chart, digital as percentage of Indian IT services revenues was only about 15% in FY17. But as the companies started reskilling their employees and then made partnerships with the newer players, mainly the hyperscalers, we saw that digital as percentage of revenues improve. For the whole industry, the digital as percentage of revenues improved to one third by FY23. During this period, we also saw great growth rates improve for the industry. Today, like I said, AI is still in very nascent stages. The reason disclosures from the service providers say that AI as percentage of revenues is anywhere between 5 to 7.5%. It's still pretty small, but we are seeing some early stages of how the companies are thinking about wading through the wave. We have seen incrementally the partnerships with the AI native platforms by Indian IT services players. This is similar to what we saw in the last generation, I would say last decade, when Indian IT services as well as the global IT services players, they started leveraging partnerships with the hyperscalers as well as the SaaS companies to for growth. So clearly, again, we are saying early stages, and as and when the enterprise-wide AI adoption picks up, we expect the growth rates also to stabilize and then improve. And three, the question on jobs. How will this impact jobs? I think like I said, every tech change that promises major efficiency and in a people-driven business. I'm just talking about the services part of the technology space, which is more people-driven. So there is a clear focus on reskilling as well as adapting. So that is why services has been the risk of obsolescence has been relatively low, because if the companies are more proactive in looking at the changes and then what are the business model changes or the technology changes which are coming through, and then proactively reskill their workforce and then realign their portfolio. Companies which have done that, they have successfully gained market share despite the scale at which they are in. We have seen this time and again. And in terms of whether this new technology can lead to job losses or an unemployment increase. Again, it's very early stages, but going by the past data, like I said, over the past 3 decades, we have seen multiple technology changes. But if you look at the left side chart, which gives the data on the US unemployment rate at an overall level as well as in the tech industry level. So despite all these technology changes, we have seen the US tech unemployment rate always being lower than the overall unemployment rate, which means that there is the demand for labor in tech space has always been higher when compared to the overall country level demand, I would say. So clearly, the demand even today it's holding up. Even today, I would say like the demand in the space is relatively higher when compared to the broader country level indicator. So, and in terms of US and US tech workforce, I think uh, the H-1B visa holders, the skilled migrant visas, immigrant visas, they augment the workforce in the US. And in terms of the percentage of people from by nationality, clearly India stands out with over 70 percentage of visa holders in any year coming from India. So clearly, the message here is like, despite all technology changes, at least in the past, we have what we have noticed that the demand in the tech space in the US is higher when compared to the overall uh, country level indicator. And second, for US tech ecosystem, India is a very important partner, as 70% more than 70% of the visas granted in the past several years have been to Indians. So just to sum it up on the AI part, I would say like it's still very nascent and an evolving technology. But if we go by the previous technology trends which we have seen, the promise of productivity is something similar to what we have seen in the past cycles as well. And if you go by the past cycles, as we see enterprise adoption of AI picks up, we see absolute dollars in tech spends as well as services spends increase over the medium to longer term. And IT services is more a people-driven business. And like in the past, we expect the companies also to adapt as well as grow in line with the changing demand. So that's the bottom line on the AI. And we will briefly touch upon the other discussion points. Probably I'll just focus here with respect to H-1B visa restrictions. I'll possibly focus only on the right side chart here. I think in the last year, in last September, the US government has uh, proposed an incremental fee on new H-1B visas. So the most important thing to notice is it doesn't increase the stock. It doesn't increase the stock of H-1B visa. It doesn't impact the stock of H-1B visa holders. So if someone is already holding a visa, there is no incremental fee or anything. So it doesn't impact the stock. Only in terms of the flow, there is a new incremental fee, and this is currently effective for 1 year. But if I look at the past 10 years, this is not the first time that there has been the increased scrutiny on H-1B visa programs, I would say. Even in 2017, the H-1B visa rejection rates also increased. And during this period, if you look at our Indian IT services companies, they started hiring more in the US. So to give some quantification, let's say 10 years ago in 2016, out of one third of the employees in the US for any IT services companies used to be locals, two-thirds used to be visa holders. But today, that ratio is more or less reversed. So 60% of the US employees today are locals. So around 30 to 40%, depending on the company, is dependent on visa. So the overall visa dependency for the sector has come down compared to the past decade. This also is visible in the bottom right side chart, where you can clearly see that the number of applications approved for Indian IT companies have come down compared to the past 10 years. So clearly there is a reduced dependence today when compared to what we had in the last decade. And the other mitigating measure is that this could lead to increased nearshoring or offshoring, so which is beneficial for the Indian IT firms. And three, if there is a resource who is definitely needed in at the on-site location, then possibly there could be a mechanism by which the fee can be passed on to the clients partly or fully. So these are some of the mitigating measures we see, which will reduce the impact on the operating model for H-1B visa restrictions. Bottom line, I think the dependence on visas for us today is much lower when compared to what it was a decade ago. And three, on the current slowdown, whether it's structural or cyclical. So probably we have plotted here the past 15 years of growth data. You could clearly see there were cycles. 11 to 16, we did see uh, yearly double-digit growth, and then 16 to 20, the growth rates slowed down to high single digits, mainly because of the initial years of the digital transition. And post-COVID, there was a pretty high growth phase at low teens. Last 3 years, I would say the growth rates has again slowed down to low to mid single digits. So there were many factors which impacted the growth rate. One, during COVID, there was an increase in technology spends across enterprises because digital was the only way to go. So there was a normalization of spends. And last 2 3 years, there have been concerns about slowdown in major economies. Indian IT services, majority of the revenues are exports. So and US contributing to close to 60 to 65% of revenues. So there were concerns about slowdown of economies due to high inflation, higher interest rates, and then in the last 1 year, due to potential impact of tariffs, etc., there have been concern about slowing down of global macroeconomy. So all these factors impacted the growth rate. So as these are getting into the base, so possibly as the normalcy returns, we expect the growth rates to possibly inch up from the current low to mid single digit growth. And the final topic is on the internet, where we have seen time and again that penetration has improved, but still we have room to go. I will just show two charts here. If you look at the left side chart, you could clearly see yes, internet penetration in India has gone up, but when compared to some of our peers, the penetration level is still lower. This is very much visible in the right side chart. You could clearly see the e-commerce penetration in India is still in single digits when compared to some of the larger economies, let's say US and China, they are still in 20s. So clearly, despite the increasing penetration which we have seen over the past 1 to 2 decades, we still see room for growth, runway for growth in the internet space. And finally, coming to valuations, uh, so our benchmark is BSE TCK index. You could see from the left side chart, mainly because of the correction which we saw in February, the valuation is now below long-term averages as well. And this sector, BSE TECK, has mostly traded, I would say, at a premium to BSE 100, mainly because the growth rates were similar, whereas the balance sheet as well as the return profiles were much superior, and the dividend yields were also much superior when compared to the broader market. So the sector always traded at a premium to the broader market. However, because of the correction, now the premium has kind of now we are trading almost at par to the broader market. And because of the correction, if you could see the right side chart, the dividend yields have also gone up relative to the market. So summing it up, currently the sector is trading at a below average valuation and a higher dividend yield relative to the long term average. So on why to invest in technology fund. I understand there are a lot of questions on uh, AI, which is the main focus point today. But if you look at a longer term picture, let's say like a 10, 15, 20-year picture, I think all of us would appreciate that the tech intensity across sectors, across all our activities, even daily, day-to-day activities for a consumer, the tech intensity has clearly gone up over the past 2 to 3 decades. And this is a secular trend across markets and industries. And if you look at Indian IT services players, they have been a consistent market share gainers in the services space globally. And three, in terms of internet digitalization in India, despite the increase in penetration which we have seen over the past 1 2 decades, still has a long runway for growth. And from an entry valuation perspective, probably the valuations are now below the long-term average, mainly due to concerns on the impact of AI and trading with a superior dividend yield. So currently the entry valuations look reasonable. So as we see the growth rate stabilize and possibly improve, like I said, this is still an evolving and a nascent technology. We will keep monitoring the same. So as we see, so if I have to look at the past trends and draw a parallel, so possibly we would see stabilization and then improvement in growth rates as the enterprise adoption of AI increases. As and when that happens, then possibly we would see the growth rates also improve. And at today's point in time, we feel the entry valuations are reasonable. So we will just quickly run you through the fund. So our investment strategy is at least 80% of the our AUM would be invested in tech and tech related sectors. The main sectors would be services, software, telecom, media, and internet, and market cap agnostic. Today we have a 60-20-20 in terms of large, mid, and small cap exposure. From a performance perspective, I think if you look at a longer term picture, then possibly in majority of the year, the sector has outperformed the broader benchmark. But if you look at the recent years, especially since FY23, out of 4 years, the sector has clearly underperformed the broader market, which is also reflected in the valuation. And this is our fund performance as of now. Since inception, we are at par with respect to the benchmark. Last 1 years were impacted by a slightly higher overweight to IT and some stock specific calls. So these are some of the key risks and mitigants. Probably I'll request you to go through. That's pretty much what I want to discuss today.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.